Well, it's not every day that a tiny country sparks a massive sell-off in gold. That's what Goldman Sachs says Cyprus has just done. Bloomberg's Ryan Chilcote sat down with the new finance minister in Nicosia. He began by asking him to clarify whether or not Cyprus is going to sell part of its gold reserves.
Yes, that has been agreed and announced from the very first Eurogroup decision. It's a Troika decision. It has been announced by the president of the Eurogroup 15th of March. So amongst the other set of measures that we are asked to implement is the sale of part of our gold reserves.
And that's a position that you won't change and can't change.
I think that's a commitment we have been asked to undertake.
Does the central bank oppose the sale of the gold?
The decision is subject to the approval by the board of the central bank, much like most other decisions are subject to the approval of our parliament. But in the case of the gold, it's the board of the central bank. That's perfectly understandable. It's their decision, like it is the parliament's decision, or they have the final say on most of these issues.
And do you have the support of the central bank to go ahead and sell the gold?
Well, it's something that will be examined soon, I hope.
So you can't right now say definitively that Cyprus is going to sell its excess gold?
Well, I can definitely say that that's the agreement we have reached.
And is it your understanding that the central bank supports the sale of Cyprus's gold?
I think there will be no problem.
And when do you anticipate the actual sale?
During the next months.
And Ryan now joins me live from Nicosia. Ryan, it wasn't exactly a straight answer, was it?
No, it wasn't. I think if you're counting on some kind of imminent sale of gold from Cyprus, clearly, based on what we just heard there, you're going to have to wait. The governor of the central bank just this past weekend told us that he'd never been consulted, and he indicated that he was against the sale. Now, the answer there from the finance minister was a bit nuanced. What he's saying is that it's not up to the governor to make the decision, it's up to the board of the central bank. The central bank board has just seen 3 of its members resign, and the government of Cyprus is clearly betting on the fact that over the next couple of months they'll be able to put the people that they want in position to make that decision. As for the specifics of the sale, he didn't want to go into how much gold they might sell or at what price, and part of the reason for that, of course, is what we were just talking about there. Goldman Sachs saying that part of the reason we had this 14% sell-off in the price of gold was because of this talk of the sale of gold from Cyprus. So clearly the government here doesn't want to undermine its position as it goes to sell its gold in the future, because it doesn't want to undermine its ability to raise the money it needs to raise to get those bailout funds from the Troika.
Don't worry, Georgios, it sets a dangerous precedent if they do sell their gold holdings, which he didn't fully say they were going to or when.
Well, they have to agree with the ECB first. I mean, it's exactly that's the point. Even if Cyprus sells gold, it's a small amount, probably around 400 million worth of gold. But then that means that other governments or other central banks may decide to do so, especially those that they are in need. The reason is, if you come to bail out your banking sector and you'd have to take a decision, what's easier to do? Hurt your depositors or sell gold? Obviously, it's much easier to sell gold rather than hurt your voters. And then what matters is the banks that they hold, the central banks, they hold larger proportions of gold. So one of them would be Portugal, for example. Even Greece holds 10 times as much gold as Cyprus. And then you have cases like Italy, for example, holding around 85 billion worth of gold. It's all the amount of the physical ETF gold holdings together. So if Portugal needs another bailout package, if they need to extend it, then they have to support the banking sector. They might say, well, we're going to do some part of that sales. And I think that's the most important bit for the gold price.
Are you bullish or are you bearish on gold, Georgios?
That's a very hard call. At the moment, I mean, we have reduced our position in gold before also before the big fall. We hold some of it in the portfolios as diversified portfolios.
Yeah.
I think it's very hard for an economist to call where gold is going to go from the current levels. I mean, you have lots of liquidity in the market. Look what Japan did, and in the past that tended to push gold prices higher. On the other side, again, as an economist, what really matters for us is like if you look into real interest rates, and if inflation is falling globally, and you've seen inflation falling globally, that means real interest rates have gone up a little bit, and that tends to move on the other direction with the gold price.
But was there anything that really changed at the end of last year that you think, in hindsight, that was the thing that triggered the start of this, what has become a bear market in gold? Because there are so many suggestions as to what it is that's driving this, which makes it difficult if we're looking for the end, you know, the signs of this sell-off halting.
Yeah, so a big difference is like lots of people were holding gold as a hedge against tail risks, and as we know, these have been substantially reduced after the OMT announcement. Also, US growth is a more substantial base than it was last year. So I think lots of portfolio managers look and say, well, my need to hold gold against this tail risk is now reduced. So probably that correction has been long overdue. You would expect that to happen at some point if you look into the fundamentals of gold as a hedge. I mean, why happen now? It's very hard to predict when the correction will be. Obviously, you also have some breaking of some technicals there, and that might have caused some of the positions to be liquidated at the moment.
What are you expecting from the ECB? You mentioned the OMT and the confidence that seems to have given to the market. We had some data out yesterday, ZEW, we had CPI numbers for the Eurozone as well. None of that giving anybody anything to worry about if they were already expecting the ECB to cut interest rates. Are you expecting that to be something that happens in the near future? Does it make a difference?
I think there are two important conditions to be met for President Draghi to cut rates. One of them he alluded in the last press conference where he said, if the slowdown hits the core, that's Germany, then I'm going to do something more, provide a rate cut. Now, that could be either refinancing rate or the deposit rate. And the deposit rate becomes more interesting if he sees the euro strengthen a lot. So if after the Japanese liquidity injection into the market, you see the euro strengthening a lot, that's the other condition. I think the second condition where he might say, okay, I'm going to cut my deposit rate into negative territory just to force the euro fall from the current levels and support the export economy. He's very hesitant at the moment. What he said is, look, I've done the OMT, I've pushed government bond yields down, now it's down to the small business sector to get some lending. And even if you cut rate, you're not going to fix that. It's that transmission mechanism that you have to fix, and rate cut won't support it too much. So I think more weak data hitting the core or very strong euro would be what is going to force the ECB to cut rates.
So what about unconventional measures to fix the transmission mechanism, Georgios? At what point should the ECB truly consider these?
There was the IMF also pushing the ECB to do more. I mean, that becomes more complicated. For example, let's look at comparison with the UK, where we've done here, we had the Fund for Lending scheme, which is direct lending to the small business sector. That's much harder to implement at a Eurozone level because you have 17 different countries with different sectors. One way would be trying to do that through the local central banks and try to direct some of the money to the small business sector, but it's much harder to implement at the Eurozone level. I think they're working very hard probably to find something new, but it's not as easy as if you just have one single economy to support them.
So how do you think that what the BOJ has done is postponing a Eurozone crisis? I'm guessing this has to do with investing in sovereign debt in the Eurozone.
Well, again, it's liquidity beating fundamentals. And what I mean by that, if we take a step back, if a year ago I've told you Italy will have no government in place, there are going to be capital controls in Cyprus, and France will be missing the fiscal targets for the next 2 years, you would think yields are going to be much higher. You would probably think Italy is going to be around 7% as it was last year. What we've seen instead is yields falling dramatically in the last few weeks from the levels, despite the worsening fundamentals. So correctly, one of the reasons is liquidity. So when you have abundance of liquidity from a central bank, then it always flows to where the yield is higher.
But this isn't Japanese money yet coming into these assets.
This is slow money.
This is hedge funds predicting Japanese money.
Well, it's the trade you want to play, because if you're a Japanese insurer and you have some yield target to meet, now JGBs, Japanese bonds yield like 0.6, 0.7, you cannot hit the target. So you have to replace that with something of potentially potentially, if you think equal quality, German bonds, for example, they actually yield twice as much right now. So you get a yield pickup. Also, if you look at investors, the consensus trade is for the Japanese yen to fall. So if you sit in Japan, you have already, you're going to get a yield pickup, and you think a better currency appreciation. So potentially, we're going to see in the following weeks or months money flowing out of Japan into hard core, like in the core of the Eurozone bond market. That also should push investors out into the periphery. So if you invest in France, a European investor, and you want to get a yield pickup, probably you're going to move out into the periphery.
At what point do the strains start to show in the peripheral bond markets again, Georgios? As you say, there's money coming from various places, which is keeping yields down. What's the tipping point? I mean, for the Spains, for the Italies?
I mean, yeah, so it would be either a small crisis, even, like, again, look at, we had all the crises, we had no Italian government, we had capital controls, and it hasn't worked yet. So it could push it maybe for 6 months or 12 months. I think at some point it gets accumulated, and there's something, some news unexpected, and that turns the tide in the other way around. If you look into Japan, it had many years of a huge debt to GDP and no strain in the JGB market. Still don't have any because central banks are